Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. We have a big episode. It looks like it's going to be another big week. Let's jump in. First up, markets took a sharp tumble Monday as US President Donald Trump unleashed fresh attacks on Federal Reserve Chair Jerome Powell, triggering widespread investor anxiety and reinforcing concerns over US economic stability. With the US President's ongoing tariff war already dragging on global confidence, his latest move, publicly mulling the dismissal of Powell, sparked a sell-off that sent US stocks, the dollar, and Treasuries reeling. The S&P 500 fell 2.5% during trading, and the dollar dropped to its lowest level in 15 months. The 10-year Treasury yield slid to 4.4% as investors fled to safe haven assets. Gold surged to a record high of over $3,400 per ounce, and the Swiss franc climbed 1% against the dollar. Trump took aim at Powell on Truth Social, demanding preemptive interest rate cuts and questioning the Fed's independence. Though legal experts argue that firing Powell would be nearly impossible, just the speculation is enough to undermine global confidence in the US financial system. Quote, any attempt to remove Powell will add to the downward pressure on US assets, end quote, said Ian Lingen of BMO Capital Markets. Monex trader Helen Given added that even the perception of Fed interference could erode trust in the dollar as a global safe haven. Traders reacted quickly, with the Bloomberg Dollar Spot Index falling 1% and option markets showing the highest bearish sentiment toward the dollar since the start of the pandemic. Meanwhile, the euro climbed to a 3-year high of 1.15 to the US dollar, and the yen appreciated to 140.5 per dollar. We'll discuss the yen later in today's episode. The backdrop to the market turmoil was a high-stakes meeting between the US President Donald Trump and top US retailers, Walmart, Target, Home Depot, and others, whose supply chains have been hit hard by shifting tariff regimes. With a 90-day pause in many new tariffs, but notably not Chinese tariffs, these companies are scrambling for clarity. Retail executives called the meeting productive, but the instability caused by Trump's trade policy has left some companies wary. Even with the pause, the uncertainty has made it hard for businesses to manage inventories and pricing strategies. Consumer behavior has already shifted in anticipation. Retail sales rose 1.4% in March, the biggest jump in over 2 years, as Americans rushed to buy cars and electronics before further tariffs took effect. Auto sales surged 5.3%, reflecting fears of looming 25% import tariffs. Retailers are now warning of broader economic impacts. Walmart, while noting that 2/3 of its products are sourced domestically, is working to manage cost volatility and supply chain disruptions. Target is assessing how tariff hikes will affect pricing by category, and Home Depot has stated that more than half of its products are sourced within North America. Wall Street strategists, too, are sounding the alarm. Citi downgraded US equities last week, joining Bank of America and BlackRock in cautioning investors. As Macquarie's Gareth Berry put it, quote, no further justification for US dollar selling is needed. What has already happened is justification enough. End quote. In the face of deepening trade tensions, political volatility, and threats to institutional independence, markets are signaling a clear verdict. America's economic credibility is at risk. Although, the awkward fact remains, who else in town has enough credibility either? Next up, this week Ben Hill, Europe editor of the UK-based Financial Times, published a piece arguing that the question of whether Europe needs new institutions to organise its rearmament is gaining urgency amid mounting security threats from Russia and the possibility of diminished US support under this second Trump presidency. While NATO remains the backbone of Europe's collective defence, there is growing concern that Europe must shoulder more responsibility for its own security, and quickly. The European Commission has already proposed major policy shifts, including a 4-year exemption for defence spending from EU deficit rules and a €150 billion loan facility for joint procurement. But experts argue that these measures are not enough. High-debt countries like France, Italy and Spain may not be able to take advantage of relaxed fiscal constraints. Moreover, the proposed loan fund is small relative to the scale of Europe's rearmament needs. Calls are now growing for the creation of entirely new financial institutions with greater firepower. One proposal is a rearmament bank modelled on the European Bank for Reconstruction and Development. They could fund defence purchases across EU and non-EU countries like the UK. Another idea floated by British officials envisions a supranational procurement body that would allow member states to buy and stockpile weapons collectively, spreading costs and increasing efficiency. One Brussels-based think tank has proposed a European Defence Mechanism, EDM, akin to the Eurozone's sovereign bailout fund. It would buy and own strategic assets, such as missile defence systems, surveillance capabilities and heavy transport, and could help arm Ukraine. EDM members would also agree to abandon national preferences in defence procurement, potentially creating a more competitive and integrated market. Yet questions remain. Would major powers like France, Germany or the UK agree to foreign support for their own defence champions? And could such initiatives truly function without US blessing or involvement? For now, NATO remains indispensable, but as Europe contemplates a future with less American involvement, the need for radical new thinking, and potentially new institutions, grows ever more pressing. The world is certainly going through massive transformation. If you want to be on top of the most salient developments as they happen, as our world changes and we move through these interesting times, consider subscribing to Market Update. Hit the bell notification icon and you will be. If you're getting some value from today's episode, don't forget to hit the like button. And finally for today, we move to Asia. The Japanese yen surged to its strongest level since September of last year, briefly touching 40.61 against the US dollar on Monday, as markets anticipated a potential meeting between US Treasury Secretary Scott Bessent and Japanese Finance Minister Katsunobu Kato at the upcoming G20 summit in Washington. The currency's more than 1% weekly gain reflects growing investor confidence that foreign exchange issues may be addressed on the sidelines of the summit. The rally coincides with renewed scrutiny over Japan's exchange rate policies amid trade tensions with the US. President Donald Trump has accused Tokyo of keeping the yen artificially weak to benefit exporters, a charge Japan denies. Prime Minister Ishiba emphasized the importance of fairness in currency discussions, signaling Tokyo's defensive stance heading into bilateral talks. Analysts remain skeptical about the possibility of a currency that would meaningfully weaken the dollar. Goldman Sachs economists noted that unless a broader agreement includes removal of the US's 10% baseline tariff on all trading partners, policy uncertainty will persist. Despite this, the yen remains a top safe haven bet due to rising global recession risks and investor unease over Trump's reciprocal tariffs introduced in early April. Market strategists are increasingly bullish on the yen. Barclays and Nomura have both revised their forecasts stronger, now expecting levels around 137.5 to 139. Mizuho Securities projects the yen could strengthen further to 133 by year end, assuming partial tariff rollbacks and a slowdown in US growth. Japan is also stepping up the preparations on the trade front. On Monday, it expanded its tariff negotiations task force by adding 10 new members from across key ministries, including transport, agriculture, and foreign affairs. The team now includes 47 full-time members, reflecting the complexity and urgency of the ongoing trade dialogue. The expanded office will support Rosei Akazawa, Japan's lead negotiator and Minister for Economic and Fiscal Policy. Proposals for the next round of talks include easing Japanese auto safety regulations and boosting imports of American rice. New appointees bring technical expertise in vehicle standards and agricultural policy, positioning Tokyo for more nimble and informed bargaining. As Japan braces for more intense trade discussions with Washington, the yen's rise underscores both investor caution and Tokyo's strategic push to defend its economic interests amid escalating tariff pressures. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you for another update tomorrow.